Yes, we will be sharing the recording, inshallah. Once it's finished recording, we'll post it on a platform and then we'll send out the links to the WhatsApp group.
Brother, will you share your group link to join?
Yeah, go ahead and share it right now. I just posted in the chat. I mean, I think you guys should all have it. Again, thank you everyone for being on time. Assalamu alaikum wa rahmatullah. My name is Sarfraz. I'll be conducting this webinar today. We're just waiting for a few more people to get in, and inshallah, we'll start in about 1 minute. But I do appreciate you guys being on time on this early Sunday morning, dedicating it to learning technical analysis. That means you guys are serious. That's why I have it so early. So inshallah, we'll get started shortly.
Do you have a WhatsApp group which you can share?
I think Brother Muzammil will go ahead and post that in there. Yeah, once the meeting's done, inshallah, we'll go ahead and post it. Or Brother Muzammil will post it in the Halal group.
Inshallah.
And then we'll have a chance for question and answers at the end as well. So you guys can post all your questions and we'll answer them as best as possible, inshallah. But I'm going to go ahead and get started. I'm going to mute everyone. Thank you. All right. Like I said, my name is Sarfraz. Been a little bit about myself and why I'm teaching technical analysis is I've been trading the market since about 2018, and I've been purely a technical trader. That means I've just looked at candlesticks and charts and decided whether I need to enter a stock or a position or exit. I'm not a fundamental trader. That'll be Brother Muzammil. He's amazing at that. So I've never used actually fundamentals to take long positions. And I know a lot of us here are not just swing traders. Some of us are swing traders. Some of you may be day traders. And if you're a day trader, then most likely you know technical analysis. The point of this webinar right here is to start with the basics. Basically, start from the beginning. And some of you may be a little bit ahead, but inshallah, this will be a good review. So 2018, I've been doing this, and that's right when the crypto boom happened with Bitcoin surging to $21,000 in January of 2018. And that's how I found out about trading because I was actually on a quick story. I was actually on a cruise ship, and it was one of our last days with my family on the cruise. And then people were screaming in the lobby. I guess that's where all the computers were there. And, you know, you have very limited internet access. And then we went to the lobby to find out what was going on. And people started saying, I'm rich, I'm a millionaire. I'm like, what kind of cruise ship is this? And we knew that, there was some other stuff going on there, but eventually we started hearing that, eventually I started hearing this name called Bitcoin, Bitcoin, Bitcoin. And I mean, all I needed to hear was millionaire and Bitcoin. So I came home and started doing research into what that was. And at the top of Bitcoin, when it was 19,500, I bought like 4 Bitcoins. It was the worst thing I could ever have done. And obviously, as everybody knows, Bitcoin dropped from 19,000 all the way down to $3,000. And I never sold because I knew if as soon as I hit that sell button, I'd lose all my money. But that prompted me to try to learn what I did wrong. Why did I buy at the top? And why did I almost sell at the bottom? And what candlesticks are, what are charts? Henceforth, that was my journey into trading, into the stock market, because once I learned that I could apply my technical analysis knowledge to crypto, I said, well, there's got to be another market for this. And that's when I got into stocks. And I've been trading it ever since, alhamdulillah. I did do this training back in 2021 for a small group of people right around COVID, when everybody, during the pandemic, when everybody was home. A lot of my friends and family members had lost their jobs. I was working from home. And so I said, okay, why not? I know very little, but I'll do my best. And it did help a few people. So inshallah, I hope this will be of benefit for you, whether you're a day trader, whether you're a swing trader, which is swing trading is basically you can hold a stock for several weeks, several months, and sell it, or whether you're a position trader where you hold it for several years, or you're just an investor, or you're here to manage your 401k, Roth IRA. Technical analysis can help you do that. So we'll get started, inshallah. Just a quick disclaimer before we get started. It's not financial advice, so I'll let you read that real quick. I'm not responsible for any trades that you make based off this. It's just information, education, and that's it. Our series overview will take us through 7 weeks, inshallah. Our first one being candles and charts. And then we'll go into trends and patterns, support and resistance, indicators, risk management, which is by far the most important of all of these, psychology, because we're all human, and then a trading plan. So inshallah, this will take us right to Ramadan. So hopefully we can make it. But today we're just going to be focusing on candles and charts, which is the beginning of everything. Now, what is technical analysis? That's the actual definition right there, an analysis methodology for analyzing and forecasting the direction of prices through the study of past market data, primarily price and volume. For me, technical analysis is basically opening up a chart and finding out whether the trend is bullish, that means going up, bearish, it's going down, or consolidating, which is going sideways, not really going up or down. And what I love about technical analysis is that you don't need to decipher data too much. You can open up a chart, and I'm going to go through some live charts today and show you exactly what's going on and how you can just look at it and identify a trend and figure out where you want to enter, and if you have a forecast of whether the stock is going to go up or down. So now the basics of technical analysis of anything in a market is you have a bullish momentum. Bullish momentum, for those of us who don't know it, is when the stock is moving up. Bearish is when it's moving down. Sideways is just when it's consolidating. It hasn't decided. It's undecided. And one thing good about technical analysis is that history does tend to repeat itself in patterns. And that's what I study. I study patterns and I study setups based off these patterns. These patterns have been repeated over time for the past 100 years, and they continue to repeat because most of these past patterns are based off of us. It's human psychology. It's us buying and selling in certain areas. Hence why the support and resistance part of the webinar will be very, very important because it'll just show you where to buy, where to sell. And I want to make this as simple as possible. I'm not going to complicate this because I know most of us are not day traders. Most of us are swing traders. Most of us maybe just position traders, just buying a stock and holding it for 5 years, 2 years, 10 years. So, and number three is the market is priced in. And what I mean by this is that sometimes we have earnings and you don't know which way the market may go. Tesla may have earnings, or Nvidia may have great earnings, or they may just say, hey, our future guidance is not that great, and the stock will drop 15%, right? But when you look at it technically, fundamentally, you don't understand it. Well, the earnings are good, everything is moving well. Why did the stock drop? You'll never be able to understand it, right? I mean, sometimes we'll have CPI data and the CPI data is neutral or it's good. Inflation is good. Stock market will drop. It's just the way it is. Sometimes the stock market, you cannot explain what happens to the stock market. It can be irrational as long as, longer than you can stay patient to deal with it. So that's why it's important. That's why risk management is a very important part of any type of trading plan, whether you're managing your 401k, whether you're long term, and we'll get into risk management as well. And that either makes you or breaks you. But what I mean by that the market is priced in is when earnings happen, the stock may move up. If you have good earnings, the stock may shoot up. And if it shoots up, if you look at technical analysis, if you look at the charts, you can kind of tell where the price may go up till and then stop. So you can make decisions for profit based off of that. And that's always been the case with technical analysis. Also, past performance is not a guarantee of future results. And this is true. And sometimes this does happen, hence why I'm going to refer back to risk management as being very, very important. You always do not trade more than what you can lose, right? Obviously, you're not trading your rent money, your money that you need for home. Anything that you trade will be something that you're ready to lose. You have to be ready to lose it. But instead of losing it, we manage our risk. And therefore, we can reduce the amount of money we lose or amount of money we risk, inshallah. So now the rewards and risks of technical analysis. You can apply to all market conditions, like I said. It's universal. Whether you trade the crypto, I don't trade Forex or futures, anything like that. Crypto, I'm more of an investor. I don't sell it back and forth. But I do trade stocks. I do have long-term positions in stocks where I've been holding it for 2 to 3 years. I also manage my Roth IRA. I do swing trading as well, and I do also day trade. Human psychology. So one thing about trading is that, like they say that sometimes when you see greed or fear in the market, you got to be careful. You know what I mean? When your barber knows about like Tesla is doing great. I just bought some Tesla. Be careful because most likely the people that are on the outside who don't know much about the markets, like us here, start to find out about, wow, I'm going to buy Tesla because it's shooting up. Then most likely the market is already at its peak. We should be careful because that's what human psychology is, right? A lot of people in technical analysis, they follow very similar patterns. I'm going to show you some patterns today, inshallah. And then the same patterns that you and I are going to learn, hundreds and thousands of traders follow the exact same pattern. That's why these patterns, most of the time, they work, as long as you have good risk management skills. When they don't work, let's see, bias and emotions. This is huge. Sometimes you and I can both see the same chart, but we'll have a completely different viewpoint because you may love a stock, you may love Nvidia, or you may own a Tesla. You're like, well, I own a Tesla, so therefore the Tesla is going to go up. It should go up, right? Please go up. So there's a lot of emotions involved in this. And when you have emotions involved in this, you and I will look at the same chart and I'll say, yeah, I don't own a Tesla. I own a Toyota. And I'll say that the chart is not going to go up. I don't think it's going to go up. It's going to drop. But because you own a Tesla and because you're a little bit more emotionally involved in this, you'll say, no, this chart, I can tell you that this chart is going to go up. I can see it. I can see it going up. So I'm going to go get in. So sometimes that can lead to bad decisions. So we have to leave our emotions out of it. And that I'll get to in the psychology part of this training. And sometimes we see what we want to see. And obviously hindsight is 2020. Once the move happens, you're like, man, I should have got in. Easy. This is easy. All you got to do is just get in right here and I make $1,000. Easy. Well, it's not as easy as it seems. I've been trading it since 2018. And honestly, my most profitable years have been the last 2, maybe 3. It's definitely not easy. It takes a lot. It takes a lot of chart time. It takes a lot of effort. But you know what? You have time and you can do it. It's one of the most rewarding professions in the world. Some of the best traders, if you're in the 1% group, the 2% group, then you're doing quite well as a trader. the upside is unlimited, but so is the downside, unless you manage your risk. I mean, you can go in Tesla 100 shares, we can go in 1,000 shares. And if it does move up, especially with the inauguration coming of Trump, and I'm not sure. So everybody thinks that as soon as Trump gets elected on the 20th, which is Monday or Tuesday, Monday is a holiday, so Tuesday, that Tesla's going to shoot up because they have a good relationship. Uh, I don't know. I mean, that's a good guess. A lot of people are buying Tesla. There's a lot of buying action on Friday, so that may happen. I mean, I own a position in Tesla long term, but we'll see. But you have to manage your risk. Again, it's it's okay to have an idea, a trading idea in your head, but if you don't manage your risk and you let the stock keep falling and you say, well, I'll continue to buy, then there's no end to how far a stock can fall. It can continue falling for a very, very, very long time. So, all right, investors, traders, scalpers, they're different people that use the technical analysis. Now, if you look over here on this side, let me see, where's my tools? There it is. So if you look over here on this side, this is the weekly chart. Now all charts will look the same at the end. You're not going to have like one chart that looks different than the other. All charts will look the same. It just depends on what time frame you're looking at, right? So the time frame decides whether you're a long-term trader, whether you're a short-term trader. And let me see this. Sorry, one second. Okay. So when you're a long-term trader, when you're buying stocks to hold for several years, 3 to 5 years, you look at the weekly chart, you look at the monthly chart. Is the screen not shared? Sorry, someone's saying screen not shared. One second. Is the screen shared now? Muzama, can you just check for me? It looks like it's shared.
The screen is shared. Yeah.
Okay, perfect. I just want to make sure. Okay, you guys can all see that, right?
Yeah.
Okay, perfect. So when you're a long-term trader, you're not going to look at charts that show you the daily candle or the 4-hour chart. You're going to look at something that's weekly, monthly charts. And I'm going to be showing you examples here, inshallah. Bring it up right here. And this is a live chart of the S&P 500. And as it indicates up here, this is the monthly chart right here. Now, the monthly chart meaning that every single candle here, every single one of these candles is 1 month of data. That means in this month right here, way over here, you'll see that it didn't do too well. So that whole month indicates that it was a bearish month. So what we're going to do is we're going to go through all of this, inshallah, and I'm going to show you exactly what these patterns do, why certain price points bounce at certain areas, and why certain price points stop moving up at certain areas. So as a long-term investor, you're going to look at the monthly chart. You may even look at the 3-month chart. Now, as we go out in the macro view of things, you'll understand that the stock market, every time it dips, every dip has been bought up and it continues to move up, especially in this last year. This last year, 2024, has been one of the best years the stock market has had, and I would say one of the best years the stock market has had in over like 30 years. The stock market moved up 35.6%, which is insane. Usually your stock market, the S&P 500 will move up 8 to 10% a year, if that. But this last year has been pretty crazy. That's why I feel like we're kind of reaching the top here. We're a little bit extended, but again, the market can keep going and I can jump out and then watch it leave. Hence why we're going to learn technical analysis to kind of figure out where to get out, where to take your profits, where to come out. No, so as an investor, you're going to look at the chart that says 3 months. Now, what I'm using here is called TradingView, and TradingView is free. I'm going to throw it in the chat. I like it because it's free. It has very, very, very clean charts. You can create your own watch lists. So I don't use it to trade. Sometimes I do. I do use Thinkorswim, Charles Schwab. They have a pretty good software there as well. to manage my trades. That's where I buy and do all my selling. But yeah, I do use this to analyze stocks, to make sure that my technical analysis is on point.
I'm
Um,
sorry. Are you trying to show your screen? I'm not seeing your screen at all.
are you
I don't
not?
know if that's what you meant to do.
Yeah, I am trying to share my screen, but I should be.
I'm only seeing your face.
Yeah,
And
I can
also,
I can see your screen.
Okay. You can
you
see it.
can?
You can see a black screen, right, with charts on it, or
No, I don't see any of that. I was trying to also join from a computer, and I guess I have to be let in by you.
oh,
Um,
okay. Yeah, I think everyone's admitted. If anyone's in the waiting room, then we
okay,
can.
I am in the computer side too, but I just don't see the screen except I see your face, which nothing wrong with it. But I thought I could see the chart.
Um,
Yes, same happening to me as well. I can see only the face. Yeah, I'm
uh,
just
bro-
scrolling to see
uh,
maybe something is wrong with my computer or
um,
mobile.
Brother Muzama, can you see the screen? Can you guys? Is
Me
it any?
too.
I can. I mean, if is everyone in the Sarfraz screen section?
You guys should
I
be in
can see the
the.
screen.
Yeah. Okay.
I'm
Yeah.
also not seeing the screen.
Yeah, I can see as well.
Okay, we'll try to leave it and then reconnect again. We'll try to see.
Okay. I mean, I think it's just a setting on when you guys are viewing it.
Yeah.
There should be a setting that, hey, view the shared screen, because all I can do is share the screen, and on my end it looks like it's sharing. Like I can see the outline of this area, um, like my pointers right
Okay.
here. So
All right. Well, thank you. Okay.
yeah, I apologize for that. Not sure what.
No worries. Thank you.
Okay, so I'm gonna go ahead and mute everyone. All right. Sorry about that. We'll continue, inshallah, and if we'll be recording this, so hopefully if you don't see what we need to see right now, then you guys can see it in the future. Um, so yeah, so right here, this will look at that monthly chart. And then as an investor, you're going to look at long-term charts. You're not going to look at daily charts. But then as you become a swing trader, like we have some brothers here that are some swing traders, like Brother Farhad, he swing trades, he's quite good at it. He'll look at weekly charts, but he'll also look at the daily chart. So what's going on? Like what happened yesterday? What will prompt me to take a position today based off of yesterday's price action? And then you have day traders and scalpers who will not only look at the daily chart, but they'll also look at the 1 hour chart. That means every single candle is 1 hour. And they'll look at that to make decisions, and they'll drill all the way down to, let's say, the 30-minute chart to see what's happening. And they'll drill down to the 5-minute chart. And what they'll do is they'll trade off the 1-minute chart, which is literally every candle, every single minute, it's changing. And these are day traders and scalpers. And um, so we can all use technical analysis. It just depends on what you want to do with it, inshallah. So we'll go over some of that. But before I get started, I do want to kind of show you how these candlesticks work. How we'll do the anatomy of a candlestick first, and then we'll get into how you put these candlesticks together to create patterns. And when these patterns are created, then a trend is created. And based off that trend, you guys can actually enter and exit the market and inshallah be profitable. So a candlestick is basically price action. This is just what the price did. Now we're going to focus on a daily candlestick, right? So this is 1 day. If the price had 1 day, then this would be it. So when a candlestick opens and closes green, now green obviously means it's a bullish sign. That means the market went up. So this is bull. I'm going to do my best to write with this pen. This is a bullish sign right here, and this right here, the red candlestick. Again, you can change the colors of the candlestick, but we're going to just, for the example of this webinar, we're going to stick to green means it's good. I mean, it's going up. It's red means it's bearish. That means it's the price has actually decreased and dropped. So we call that bearish. And I don't know why they call it bulls or bear, but one person explained that a bull has horns, so it goes up when it attacks, and a bear has claws when it goes down. But I don't know. That's just silly to me. But so when a candlestick opens and when they start forming, you have an open price and you have a close price. Now, when you're talking about and when you talk about a candlestick that's bullish, the open price will usually be at a certain level, like right around here. And then what happens with the price action is sometimes it'll drop down, right, like this. But it doesn't close there because Obviously, the markets open at 9:30 a.m. Eastern Standard Time, and they close at 4 p.m. So within that time, the candles can do whatever they want. And at the end, when they close, then you have a daily candle that will form like this. Now, this will be the candle that will form at 4 p.m. Eastern Standard Time once prices close. But throughout the day, the candle will move in different directions. You know, the candle will move down like this, but if it doesn't close there, then it moves back up. And then as the price action moves up, you'll see the body being created. So this right here is the body right here. I'll show you right here now real fast. So this right here is the body of the candle. That's where most of the price action happened. So basically the price opened at this level, it dipped down here, but obviously it didn't close here at 4 p.m. It went back up and it went all the way up to this level. It didn't close there either. There were some people that came in here and they sold, right? The selling action happened. These wicks represent that the fact that the price did go up. It did go at that certain level. Let's say this price action is $10 here, and this is $5 here. So in total, this candle moved up $5. So you can say that it opened at, let's say, $6 right here. It dropped down and tested this $5 mark. And then after that, it moved all the way up to $10. And then people started selling because, like, hey, they bought the stock here at $5. They made $5 a share, so they sold. So hence a little bit of selling happened. So eventually it was 4 o'clock, time expired. So the candle closed here around, let's say, $9, right? And now because the candle closed at $9 and not below 6, you call this a green day, or you call this a bullish movement. Hence, you can take that and derive your trading plan, or whether you want to buy or sell for the next day. Now the same thing happens if a candle continued to move down this way. Then you have something of a bearish candlestick. And when you have a bearish candlestick, let's say the price opens here and it opened here. Let's say it opened down here, and this is that open price. And it went up. And yeah, as the candle goes up, it's going to highlight green. Anything above the open price, any price that goes above the open price, the candle's going to highlight green. But let's say a lot of people sold in this area and the candle started dropping. As soon as the price goes below this open price, as soon as it goes below it, you'll see red. Now that means the price of stock is decreasing, right? And as the price of stock decreases, it'll become red, red, red. And so in this specific example, the candle moved all the way down to right here. It hit this area, and there were some people that started buying. But by the time 4 p.m. hit, the candle closed well below its open price. So that means it had a bearish day, or it had a red day. A lot of people say that, hey, Tesla dropped today, and basically it had a red day. So that's how you would decipher whether a candle is red or green. So when we show you like in the real chart, and then let me go back to like the monthly chart right here, or the 3-month chart. Now this last month in the S&P 500, if you look at January, and if you're looking at this chart right here, if you look at the bottom in this area, they'll show you the dates. So I'm going to zoom in on this candlestick, just to show you a live example. So if you look at this candlestick right here, this green one right here, this is how the market closed. This is how the market is doing well this month in January. In the last 19 days, this is how it's done. That means it opened here. It opened here. This is how December ended. December ended way down here, but then the market opened right here in this area. And then you can see the price points right around 5,800. Between 5,800 and 5,920 for the SPX, S&P 500. It opened right here. And it did drop. It went all the way back here to this price point. And this price point was around, let's say around 57.70, that area. It went down there, but a lot of people bought. A lot of people. And I'll explain why people bought here, because you see these two candles over here? They close in that same area. So price came down here to discover that there were a lot of people that stopped right here, came here, it stopped, and it went right back up. And then it went above the open price. So if this is the open price, it shot up all the way up to this price, which is right around, let's say, 6,000. And now it's decreased a little bit. So far, the S&P 500 is having a green month, a bullish month, right? December wasn't so bullish, right? It started off bullish. It may have started off bullish right here. It opened right here. it went up to all-time highs, right? Whatever that was, 6,000, 6080 in this area right here, or 6090. It went there and it started closing. But as soon as this is the open price right here, so as soon as this drops below the open price, it starts becoming a red. So therefore, this was a red month. So that's how you decipher candlesticks, and you can decide whether a month was green or red. Now, I'm just speaking about months. That means each candle actually represents 1 month, but this can be for weeks. Now, if I click the weeks button, it'll show you all the weeks in January. So far we've had 2 weeks right here, right? So these two candles make up January. Now we need 2 more weeks, just like December had 1, 2, 3, 4 weeks. And you can see that most of the time December was down. So hence, if you take the total, the average of all these 4 weeks, then you get a red month. So far right now, as you can see, the green candle is bigger than this red candle. So therefore, we're having a bullish month, but this can change. If the price goes below this down here, then January may end up red. Let's hope that doesn't happen, inshallah. But that's just to give you an idea of how candlesticks work. And that's the anatomy of a candlestick. You have your open, your close price. As long as the close price is above your open price, it'll be green. If the close price is below your open price, it'll be red. And you can learn that in TradingView as well. So, all right, we're going to go back in here. All right. There's different types of candlesticks, and some candlesticks will be a solid line like this. And these are clear right here, so I can just show you how these work. It can be bullish or bearish. So let's just, in this example right here, and these are not my screenshots. I've taken an accumulation of a lot of different screenshots to figure out what's best to learn. And this webinar has changed a lot. I mean, the last time I did this webinar was 2020, 2021, and it's from what I knew back then. But since then, I've eliminated a lot of the noise, a lot of the stuff you don't need to learn in order to become a technical trader. So we're just going to be focusing on the meat of the matter, what actually matters, and what will actually get you to start taking positions based off of charts. So when you have a candle like this, a full candle, this is called a very bullish candle. Now just imagine this candle is green, right? Just like I showed you the examples in TradingView. Imagine that candle is green. So if a candle opens here and closes here like this without any wick at all on top, that's a very strong candle. So most likely, following this, which you can make the interpretation that the next day will also be bullish, will also be a bigger candle. So some people take positions right here, or they take positions in this area for the next day to profit from it. Now, then you'll have candles with this little top tail. Now, like I said, like these little wicks, or the little tails means that the price action did get to this level. It did get there, but it couldn't hold. A lot of people sold in this area, so therefore it closed, but it didn't retrace all the way back to the open of the candle, which is down here. It went maybe a quarter of the way. It still shows that it's still a bullish sign. It's not as bullish as this, but it's still bullish. And then you have wicks that are much, much more deeper, and they close in the lower body of that candle. So, I mean, if this is the half of the candle, then this is closing below. Now, you have to be a little careful here, because why are people selling in this area? You have to ask yourself that. A lot of people are selling. This is psychology, right? It's not just us. If all of us sold one stock at this level and we're the culmination of the stock market, then the price is going to drop, right? So we have to wonder, why are people selling here? Is this an important price level? Are these the all-time highs of the stock? Did some news come out? Was there a catalyst? That's where our research comes in. You want to know as much information as you possibly can take before you make a decision, regardless of whether you see it on the charts or not. But this shows that the candle is not as bullish. That means we got to be careful that we may see some downside coming tomorrow, right? This is a little bit less bullish. Now, when you see a candle that's right in the middle, where it's like, yeah, it went down, came back up, went up, came back down, and kind of ended in the middle. It's a very neutral, or it's not really bullish or bearish, but as long as this closes green, as long as it closes above the open price, if this is the open price right here, this is the close price, you can still say that it did have a green day. It was a bullish day. Yes, it didn't close strongly, but it did have a bullish day. And when you start seeing candles like this, like these neutral candles with a very small body, now remember, this area right here is the body, right? And the body is where the price opens and closes. That area in between the open and closing price is the body. This area is called a wick. this gives you a lot of information. This shows that, hey, look, the price went up there, but it got sold off. But in a situation like this is a very neutral stance. That means, you know, the bears pushed it down, it hit a price level, came back up, hit the top level, but nobody could decide. So it's very neutral. Now, the next day, it could either move down or up. You know, your guess is as good as mine, especially when it's neutral. And the bearish candlesticks are similar, right? Your open price is up here instead of your open price being down here. And then now the price has moved up, couldn't hold that level. So it moved all the way back down. Couldn't hold this level. We had some buyers here and it started moving up, but 4 o'clock hit. But as soon as 4 o'clock hit, we're done. I know some of you may be asking, well, we have after market hours, we have pre-market hours. We can discuss that in a more advanced course, but right now we're just going to focus on the market open, right? Which is 9:30 a.m. Eastern Standard Time all the way to 4 p.m. So that's what these candles represent. Yes, you can enable after hour trading, pre-market trading and see different charts and candles, but most of the time throughout history, people will focus mostly on the regular hours of the stock market. So this right here will be neutral. As you can see down here, there's a little gauge right here that shows that as you go this way, this is more bullish. You have fuller candles. As you go this way, these are more bearish candles. And this is very similar to this. The open up here, close up here, a lot of wicks, kind of indecision. You know, not as neutral as this, but it's still a bearish day. Now this right here basically says that the price opened here. It dropped down hard, but a lot of people bought in this area. Maybe institutions got in there. You know, a lot of people, there's a lot of buying action. So the price came back up. It rallied back up, but unfortunately it didn't have enough time to close above this level, which is the open. So therefore it was a bearish day. It was a little bit less bearish and not as bearish, but it's still bearish, a red candle day. This one's similar, a smaller wick. So it's more bearish. That means, hey, careful getting into the position here because most likely it's not going to go up. And this one right here is the most bearish. I mean, this was just a tough, big drop, especially after, I remember FOMC happened a few weeks back. The stock market has been on a slight decline, and I'll show you that. So this is very bearish. This basically means that it's a very high likelihood that the stock tomorrow or next week will drop. So you want to be careful getting into positions when you see bearish candles like that. Unless, of course, you're trying to buy it at a lower position, right? And you try to buy it at a lower price point. Because some people are long-term traders here. Some people are position traders here trying to add to their position. So obviously, if you want to buy and you're trying to add to a long-term Tesla position or an NVIDIA position, then you only want to buy on the dips. And the dips are these candles right here when they dip down. Because you don't want to buy at high points. You want to lower your average cost as much as possible, especially if you're holding for long-term, right? All right. Now here are some different types of candles. Anyways, I want you to ignore the names. Yeah, you can learn some of the names, but the names change. They continue to change. Everybody calls it something different. But when you have candles like this, these are some bearish candles right here, right? This is something called, sorry about that. This is something called a hammer candle, right? A hammer candle, obviously it has a long wick on the bottom, right? And it ends up green because it opened at this level. Now remember, a green candle opens at this level and it closes up here, right? But it did dip down. A lot of buyers came in right here and pushed the candle right back up. And they call this a hammer because, you know, it looks like a hammer, whatever you want to call it. This is an inverted hammer. Inverted hammer, basically, I showed you this example before, that the price opened here. It went all the way to the top. And then there was a lot of people selling in this area. So it closed like this. And I'll show you some inverted hammers once. I'll go through two or three of these, and I'll show you some live examples right now. Because there's nothing like live examples. These are examples that actually happen in the charts. So we're going to go back to TradingView. Hopefully you guys can all see that. 1 second, let me delete all of these, clear my drawings. Okay, so right off the bat, I can show you an inverted hammer or a candle right now. So this is the hammer that we're looking at right here. Right here, there you go. This was the month of December 24th. So the week of December 24th, which was the Christmas holiday week right here. So you can tell that there is a hammer candle. yes, not everything's going to be as perfect as the one I showed you in the example, but what we can note from this week right here in December was that price opened here. It dipped all the way down to here, that's around 5,800. It bounced off that 5,800 level and it came back up and it came right here and then it dipped back down just a little bit and closed in this area right here. I mean, this, like they said, is not as bullish as a candle like this, right? A big candle like this. Now you may say, oh, surprise. You said when you have a big candle like this, a big green candle, the stock market is going to go up the next day. Like I said, the stock market is irrational. It doesn't exactly listen to my thoughts or your thoughts. It does what it wants. But when you see a candle like this, which was the week of November 24th, that's a huge move, you know? And when a big move like this happens, let's say you bought down here. Let's say you had a position somewhere over here and this big move happened. Wouldn't you take profits? Some of us would. Some of us are swing traders. Not everyone's holding it for 2 to 5 years. And some of these guys are day traders, right? So they are going to take profits in this area. So hence, this is profit taking right here. Because what happened following that? We had to move up, right? We moved up from whatever, 6,000 all the way up to 6,100, close to it, right? So that was a move up. So people sometimes buy this dip after a strong move up so they can get a lower price point. So that means it's almost half this candle. You know, sometimes like I said, hindsight is 20/20, right? Let's say this week goes past and you go to the next week like, man, I wish it was down here. I wish it was down there. I wish I would have bought it. Well, now you get the opportunity, but then you're like, whoa, the candle's dropping. I don't know if I should get in. You know, there's another thing, it's psychology of people, is that people want to buy at discount prices. And you know that from Bitcoin. You know, I mean, Bitcoin has surged up to $105,000 as of today, 106,000. The price wasn't very high. It was at $60,000 hovering in that area. And a lot of people have said, well, this is too high for Bitcoin. No one wants to get in here. No one wants to get into Bitcoin. Now that it hit 100,000, everyone is buying. I don't know who can afford 100,000 Bitcoin. It's too rich for my blood. I can't afford 100,000 Bitcoin, one Bitcoin. But a lot of people are buying at this point. Hence why the price is being stable at 100,000 and, you know, moving up to 105, 110. Obviously, you have a lot of institutions that are coming in, but it shows you the psychology of people, that nobody wants to buy a stock when it's at discount levels. And that's amateurish thinking. Now, this is what I want to tell you guys. You guys are in this webinar for a reason, that if the price does drop and you're looking for long-term gains, you want to buy at lower price points. You don't want to buy at higher price points. You want to buy at discount price. And hopefully armed with technical analysis knowledge, you'll be able to make that decision, inshallah. So anyways, so that was an example of a hammer candle. You're going to see these candles everywhere. Now, this is more of an indecision candle. You have another hammer candle right here. This is a good example of a hammer candle right here. Now, we talked about hammer candles, that right after this hammer candle, you had a drop. Why? Because hammer candles are not exactly as bullish as they are, right? Now, if you see this, it's a hammer candle like this. This is less bearish, right? It's not as bearish as this is an upside down hammer candle. But basically, a hammer candle means that you've had price action, but price action closed very much at the top. So we're not sure. You know, the price did drop, but people bought it back up. Yes, there could be continuation, but in this instant, there wasn't. There was a big red candle the next day. So most likely, you have to be careful, right? These are all different candles that represent different things. For example, a green hammer candle at the top doesn't exactly represent bullishness. It means that, you know, the price may correct. Now, a red hammer candle, I know sometimes it's inverse. Sometimes that may mean that if it happens at the top of a trend and at the bottom of a trend, there's a difference. So let me go back a little bit, right? If you're looking at hammer candles or any type of candles, it depends on where in the trend it happens. Now, a trend is basically, I'm getting a little bit ahead of myself, but a trend is basically a culmination of all these candles put together. You have a trend. As you can tell right here, price is moving up, so you have a trend that's going up. So if a hammer candle happened up in this area, that means you have to be careful because the price may correct. If a hammer candle happens down here at the bottom of a trend, most likely the price is going to go up. But we'll get to those details as we go deeper into this webinar. We're going to continue on, inshallah. So obviously, you have your bearish candles right here, and these are neutral candles. These are continuation candles, and I'll get to that as we find out more about candlesticks. now that we have candles, when we put these candles together, you have something called patterns, right? And patterns is how you trade something. One candle does not help you do anything. It does not give you anything. It's like saying one word in a sentence, saying the. There's nothing else, right? So you have to understand that candlesticks put together, they create trends and they move in patterns and waves, right? And why doesn't the stock market just go up? Why does it always have to dip down, right? Because stock market moves in waves, right? You'll have wave one and it'll go down a little bit, go up, go down. It's called a zigzag pattern of stock market, right? So when you have multiple candles, what makes it go up is you have more green candles than you have red candles. So the red candles are going, the green candles make the stock price go up. Obviously, the red candles, if you have enough of them, they'll make the stock price drop down. And how do you know whether these candles are going to be pushing it down or up? Well, you don't know. What you have to do is you have to take the larger picture. And I don't like really looking at this as much, but this is just a diagram of how the stock market moves up and down in zigzags. I like to work off real charts. So we'll spend most of our time looking at actual charts. So I'm going to go back to the monthly chart. And then the best example I like to use is the dot-com bubble crash and the financial crisis. So as you can see, we're way up here at $6,000 for S&P 500, right? Now you see these two little bumps right here, down here. Those are the crashes of the stock market. I know they look insignificant compared to this huge move up, right? This looks nothing, right? But this was big. This changed the game in the stock market. This changed everything. Yeah, I was a kid back then. I wasn't really trading the markets back then, but I heard about it. I heard about people losing their jobs. My uncle lost his job in this financial crisis right here. I heard about the dot-com bubble. So yeah, that's where we're at right here. And I like to use that as examples because they're very good examples of what can happen in the stock market and how you can recover and also make a lot of money. So right in this area, around 2000, which, if you go all the way down here, you'll see that it's right around 2000, the stock market dot-com bubble burst, which is, let's say, January of 2000, April of 2000, right here. Now, when you look closely, you'll find out that there's a few hammer candles right here, right? Two of them. Two hammer candles right here at the top of a trend. That means the stock market rallied from whatever price it was at. Let's see what price it was at down here. Let's say $200, right? 200 to 6,000. Obviously, we're talking about 1987, but just the move up here, if you go all the way up here, this price point right here is about, let's say 1590, let's say 1600. The stock market rallied from 200 to 1600. And this is where the dot-com bubble happened. And now, obviously, hindsight is 50-50, 2020, sorry, it's not 50-50, 2020. And then when you come up here, you can tell, oh man, yeah, I see the hammer candles right there. I see that there were two candles up here that showed that it wasn't very bullish. There was a green candle and a red candle, and then it was an inverted hammer right here, right? So I'm going to zoom in a little bit more right here. And so you guys get a better picture of what happened in 2000, right? So you see this is a hammer candle, right? So it shows that we had a strong move right here on this guy. We had a very strong move. And then this guy came, and this guy was a hammer candle. This shows that it's less bullish, right? This is all bullish. People are like, whoa, we're making a lot of money. This thing is never going to go down. And then you start seeing candles like this. You see hammer candles, right? And then you see another hammer candle that's red. Then you see an inverted hammer candle like this. Now this basically means that the pressure up here is getting strong and people are looking to sell. And obviously, if you look at technical analysis and you never knew about the dot-com bubble burst, right here at this point, as a technical analyst who's been doing it for 5-6 years, I'll tell you that, okay, that's not a good area to enter. It's a good area to get out right now or take your profits because the stock market's had a nice move up. It can only move up so much before it actually pulls back a little bit. And look, every single candle here is 3 months. It's a 3-month candle. So this candle right here, it's 3 months of data. And I just do that for visualization so the chart doesn't get too large, right? So even if technical analysts, we don't really focus on news as much. We just look at charts straight. That's why when I say sometimes things are priced in, they're priced in, right? Because I mean, If a technical analyst looked at this area and said, wow, we have a hammer candle, okay, the pressure is, the buying pressure is slowing down. Now we have a red hammer candle, okay, now we have some pressure for it to go down. Then we have an inverted hammer. Now, why inverted hammer, right? Inverted hammer basically means that the price went up, the stock went up, but then there was a lot of selling here. There was a lot of selling here. There's a lot of selling in this area, and it pushed the price down below its open price. And when the stock price goes below its open price, it turns red and it closes red. So for this 3-month period, this candle represents 3 months, it was red. And now you don't have to jump out right here. Now I'm going to zoom in a little bit more closer to just show you where people may have jumped out, right? Now, where I would have jumped out if I knew technical analysis back then, or now that I know it. Now you see these two candles happen. Now this guy right here forms. Now the price point is fluttering right around this area, right? The price point is kind of holding this area right here. But this candle comes in and it pushes below strongly, right? It breaks this area, it breaks below this, it breaks below all of these levels, and it pushes all the way down to the bottom of this candle right here, right? It pushes all the way down here. That's a strong move down. And that's also an indicator that, look, we got some lows coming in, right? We got new lows, right? It went below this low, it went below this low, it went below this low. So now we have a new low. Now, how do you know whether a stock is moving up or down? Let's go through that before I explain this more in detail. Let's see. Okay, so this is what I wanted to discuss before we went in, right? When you know a stock is in an uptrend, you have higher highs and higher lows. I know, what does that mean? What's a higher high? What's a higher low? A higher high is when the price moves up, it retraces, and then it moves up further than this last high, correct? So let's say the price moved up right here at this point, and now people sold. They sold, but their selling wasn't strong enough to bring it down to this level, right? It stopped right here and it moved up. But what the price did do is it went higher than this last pivot high. We call it a pivot because it pivots down, right? For simplicity's sake, we can just call it a high. Now, as soon as the stock price breaks above this, we call this a break of structure. That means the structure was there, it went down, now it's broken, and now it's going higher. As soon as that happens, we have a higher high, right? When a higher high happens, you know the stock is moving in a bullish direction or it's moving up, the price is moving up. And now, the only way to really tell whether there's an uptrend is we need 2 points. We need 2 highs and 2 higher lows. So when the price does retrace, and the price will retrace, if it doesn't go below this low, which is way down here, then we have bullish momentum. Now it's moving up, right? It's a higher low. So this low is higher than this low. This high up here is higher than this high. So hence, now you have a positive or a green trend that's actually moving up. So you can make decisions here, or you can make decisions at this point right here to enter the market. This would be your safest bet to enter. Obviously, it could consolidate and drop, or you can get in here. You can get in at this point as well, and then have your stop loss here. But that's what indicates a market from moving up, that when you have higher highs, higher lows, higher highs, higher lows, is the market is moving up. And I'll show you an example here in TradingView. And we'll go down to the monthly chart so I can show you right before the dot-com bubble burst, right? So we have, it's not going to look as pretty as this. Nothing's going to look as perfect as this. It's going to look a little bit messy, but it's your job to decipher it and investigate and figure it out, right? So if you look at this area right here, you have a very clear high at this area, right? You have a high, and then you have a low, right? Right? And now the stock market moves above this level, and now you have another high over here, right? And you have another low. So now you can tell just from this that, hey, look, the stock market is moving up, right? Higher high, higher low, higher high, higher low. So we have a trend. We have a trend now that the stock market is moving up. As long as you have a higher high and a higher low, the stock market continues to move up, right? So that's how you figure it out. I mean, you can even go way down here and do it, right? You can say, hey, this is a high, this is a low, this is a high, this is a low. Another higher high, another higher low, right? Higher high, higher low. As long as these lows are above each other, you know that the trend is in place, you are moving up, right? And in this example right here, when the dot-com bubble actually burst, you had lower lows, right? So if you say this was the last higher low and this was the last higher high, where's the next low? Right here. Right here, exactly. It's right here. Now this low is lower than this low. So what does that mean? This is a lower low. Now you say, okay, fine, this is a lower low, but the next high, as long as it gets above this, we're still good, right, Sir Fries? Right, that's exactly right. But it stops right here. It doesn't even go above this. It stops right here and it starts to drop. Now, when do you actually know that the trend has changed from a bullish trend, which is going up, to a bearish trend, which is going down? Something has to break below this low, right? It has to be a break of structure. The structure is moving up. So how do you know the structure is moving down? We need a second lower low. So once price breaks below this level, which it did, and formed another lower low, now you know that the market's moving down. But sometimes when we're in a long position, we're like, no, 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 no. It's going to move up. I know it. I know. Okay. Well, let's see. Hopefully, if you can get above this price right here, then yes, we're back in trend. But what happens? We get a higher low. We get another low, but it's not as high as this. So therefore, I'm sorry, it's a lower high, right? It's a lower high and this is a lower low. So you see, we have several lower highs. This high is lower than this high, which is lower than this high. So now you're in a bearish trend, right? And the next stop right here is another lower low. It's lower than this low, correct? And then another lower high, which is lower than this high, right? So now you know you're in a bearish trend. So a lot of people start selling late. Then they're obviously not going to sell, up here because it's still in trend. But as soon as you have that first lower low and a lower high and it starts pushing down, most people started selling here. Hence why you have strong selling pressure. Strong selling pressure. Look at this: 1, 2, 3, 4 months. Right in this time. What was that? This time was 2002, April, all the way to July 2002, right? 4 huge months of just solid selling pressure because people realize that, hey, look, we're actually in a downturn. We're actually losing a lot of steam. My 401k is down, my portfolio's down. So hence the dot-com bubble happened, right? But eventually the stock market will stop moving and it'll go sideways for a bit and then push back up, just like it did here until the financial crisis hit in this area of 2008. So let's go back to the example again, that once we're in an uptrend, we have higher highs, higher lows, higher highs, higher lows, and then we have a sideways trend. And a downtrend, however, is obviously lower highs, lower lows, lower highs, lowest lows. So hopefully you guys can understand that. These charts you can all find in TradingView. I'm trying to check the chat as much as possible, but I will check. We'll go to Q&A session shortly, inshallah. But these are all TradingView charts. This is free. You can create a free account at tradingview.com, and you can access all these charts there just to study. Okay. All right, let's move on, inshallah. Pullbacks, right? Pullbacks happen all the time. That's a very, very important thing. Now, I know you can look at this whole thing as a pullback, but it wasn't a pullback. A pullback is just a temporary pause in an uptrend, right? If you have an uptrend in place, a pullback will happen. A pullback is basically when people take profits. Everybody takes profits at different times. Everybody has different profit targets, right? You may want to get in at Tesla at whatever it is at 415, 420 and say, my profit target is 500. That's where I get out. So I don't sell anywhere in between, right? But remember, you have position traders, you have swing traders, you have day traders, you have scalpers. Scalpers are basically, they work by the second. I mean, each candle is like 1 minute long and they get in at the first minute, they sell at the 10th minute and they're done. And they may sell 1,000 shares. So that'll also bring the price down a little bit, right? So pullbacks are actually very healthy for the market. When I enter into positions, I only enter at pullbacks. I never enter when we're at peaks. I always enter in a pullback. And I'll show you how to differentiate between a pullback. A pullback means a temporary selling, lowering in price, so you can buy and then move back up, versus a trend change, right? A complete trend change. And we know that by, and I just explained that by when you have lower highs and you have lower lows, that means a trend has changed. But when you have when the stock market keeps going up, you don't have to worry about that. So I just enabled a volume indicator right here. Volume is one of the most important indicators that'll kind of tell you whether the price is going to move up or whether the price is going to move down on this pullback. So let me go into the weekly chart here, and I'll show you, inshallah, 1 second. All right. So this is a more micro view of the charts where we're going like each chart, each candle here is 1 week long, right? So hence you're going to see a lot more data, a lot more candles, but the overall picture is the same, that we did hit this area right here and we went into a bearish market. And we were in a bearish market from 2000 March all the way down to October 2002. For 2 years, the stock market dropped. And every time it hit this little bump, and I said, okay, well, it's going to go back up. People got in and they were disappointed again. So that's why it's very important to understand that higher high, higher low mentality, how trends work, that if you do have prices that's moving up with a higher high, higher low, higher high, higher low, higher high, higher low, that you are in a bullish trend. If you can just remember that, just that one thing right there, you can actually trade the markets. You'll know which direction they're moving in. And if they're moving down, you know they have a lower high, lower low, lower low, lower high, lower low, lower high, lower low, right? And that's what happens to a market when it's in a downtrend, right? Now, pullbacks are different, right? Pullbacks are just temporary pause in price, and people are taking profit at this level. And I'm going to zoom into this area where there was a pullback here, right? A pretty good pullback and a good time for you to get into the market if you missed a train over here. Now, if you were here in right around October 1998, you know, time is irrelevant, and you missed this huge move up, there was a pullback to correct, retest this areas, and then have a huge double, triple move up, right? So sometimes when this happens and it doesn't break below, let's say this low, then it's a good idea to get in. And sometimes the price will come here and kind of consolidate. They'll go sideways a little bit, and then it'll start moving up. So as soon as you move above this, that's a good position to get in right there. That's a good area to get in, because you're not getting in here because thinking that the price may go down here. But anywhere here you can get in. And if the price hits below this and it goes below that, you can always get out. Hence, this would be your risk, right? This area would be your risk, but your reward would be up here. All right. So that's risk versus reward, and I'll go through that when we get to the risk management part of our webinars. But yeah, these are all pullbacks. They're low volume. The volume will be a little bit lower when you go through these pullbacks. Let me go to a daily example so I can show you more in detail. Don't get confused. I mean, I know there's a lot of things going on this chart, but I'm just zooming in. All right. See, here's a good example in this area right here, right? These are all daily. We're on the daily chart, so every single one will be a day. So price moves up here, right? We break this high and we get higher like this, and we have a low way down here, right? So now we can say that, okay, we are officially in an uptrend by seeing this higher high. But I don't want to get in here. I want to get in a little bit lower. I wish I got in right around here, or I wish I got in right here because I missed this whole move, right? Now, price is going to retrace back, and when it does retrace back, it goes in waves as well. It goes in smaller lower highs and lower lows. So you'll have a lower high here, a lower low right here, a lower high there, and a lower low right here, right? And then price will consolidate. It'll break structure right here, break structure right here. So usually a good area to get in is when it breaks structure, and then now you have a higher high, right? So yeah, you didn't get in down here, but you got in here instead of up here, right? So it's a better price point that you get in here than up here. So that's how you play pullbacks, is when it pulls back and it breaks the structure right here, that the trend is changing, you have a higher high, then you can actually get into the market and go, right? Now, if you have consistently lower lows, lower highs, lower lows, let's say the price doesn't stop here, it goes down here, and it goes like this, and it goes below this level, now you have to start worrying, like, why did price go below this level, right? Where's it going to go next? It's going to go right here and then drop this way, right? So now you're not only in a pullback, but you're actually in a slight downtrend, and a slight, what a lot of people call correction, right? You can have multiple names for it, but this correction can last months, it can last years, right? And then people say, okay, we're in a bear market now. Okay, look, we had a correction for the past 6 months. It's officially a bear market. But different people have different definitions of what a bear market is versus what a bull market is. But yeah, that's what pullbacks are. And pullbacks are necessary to get in. And right here, this little chart that I found up here, it says, you know, the price moves up here, you pull back here, you buy right here. It's not as easy as that, so don't pay attention to this. It was just a great example. All right. We'll move forward to support and resistances, which is the bread and butter of my trading. It's how I decide where I can get in. Support and resistances, I want you to think of it as floors and ceilings, right? Price will bounce off a floor several times. Now, why does price bounce off specific areas? I don't have an answer for that. That's just the psychology of the market, that most people want to buy down here rather than up here, right? Just that's where people like to buy. So support is an area where the price has been stable, where in the past, in the history of this stock or the security or the crypto coin that you're trading, that price has come to this area and always there's been action here, that people like to buy in this area. And mostly it's not you and I, it's not the retail traders that make this happen. It's the institutions that get in at this point. And we'll go right back to our trading view to show you areas of support and resistance. I'm going to go back to my 3-month chart. So the 3-month chart means every candle is 3 months long. And then we're going to dig into where this, we're going to go back to our major correction here. So obviously there's the dot-com burst. This is the financial bubble, right? So right away, I can show you very easy areas of support and resistances, right? So a support is an area where price has been now, for example, here, well, how do I know where there's support here? Because this is new price discovery. Price has never been up here. So therefore, there's no support here. So right, so it did create a support here, right? So if you draw a line this way, now you ask yourself the question that when the dot-com bubble burst, price dropped down to, let's say, 750, the S&P 500, and it stopped at, let's say, 1500, right? 1500 to 750, right? 50% drop in the stock market, correct? But why here? And why here again at the financial crisis? I mean, the financial crisis, no one could predict the financial crisis, correct? Everything defaulted, mortgages defaulted, all kinds of stuff happened. You couldn't predict the financial crisis. But what if you knew technical analysis? What if you knew technical analysis back then? Like if I knew technical analysis back then, and I know the price is moving up in this area, I'm like, uh-oh, I have to be careful. Because last time price came to 1550 in 2000, which was about whatever, 8 years ago, you know, price fell. So obviously, if I'm riding this wave up, I don't care whether it's a financial crisis. I don't care if there's a war. I don't care if Warren Buffett is selling every single one of his shares. I know that this area right here, because this last area here, this is very important. This is the most important thing you could possibly learn today, is that because price sold off here, price has a very high chance of selling off here again, right here in this area. So whether the financial crisis happened, that's why as technical traders, we don't really, I'm not going to say we completely don't care about news. I read news every morning. I read news every night, quick snippets of it, but it doesn't impact my trading. I just know what to watch out for. I'm like, okay, there's some news. Tesla didn't hit its numbers. I just use Tesla because it's an easy example and it's one of the most traded securities in the market, right? Tesla didn't hit the numbers that it had to sell. Okay, the price may drop, but I'm going to let the charts do the talking. Now here, if you look at this example, 2008 financial crisis starts, correct? Or that's what they say, right? 2007, October 2008, January 2008, that's when the financial crisis started, right? Now, this is the catalyst for the stock to drop. But as a technical trader, you already know that if you got in anywhere in this area, that if you're, let's say you got in here, because the big drop happened, now you have a break of structure right here. So you got in right in this area. When you're riding this wave up, you're going to sell something here. I mean, you may not want to sell your full position here, but you're going to take profits right here, right? Because then when it starts dropping here and it goes past this low and it goes past here, you want to get out of your full position and at least salvage whatever you have left, right? So now the price drops, right? Price drops hard. I mean, not one green candle right here. And we're looking at the 3-month chart. Here, at least you had green candles, right? A little bit of hope. Here, no hope. All hope is gone. Financial disaster, loans defaulted, unemployment, everything. the whole recession happens right here. There's a big bear market that happens, right? And it happens from 2007, October 2007, all the way to April 2009, January 2009, right here, it starts to recover. So you're talking about 2 years of just red, red, red. This is probably the worst time to trade. Nothing, no trades will go in your favor, right? But one thing you realize is that what happened? Where did price stop? Price stopped at the same area it did in the dot-com bubble burst, right here, 750, right? Why did it bounce off of there? Why? Did people plan that the financial crisis is only going to last at a certain time? It's only going to drop at a certain time? No. This is technical analysis. This is why it's used by institutions. It's used by hedge funds. True, they also couple that with fundamental analysis. But technical analysis says that 750 is a support level. This is what I mean by the floor. This is a support level. And this is a major support level. The higher in the time frames you go, and if it creates areas where there's support and resistance, like this is resistance up here, right? This is resistance on top. You also call that the ceiling, right? And this is the floor, this is support, right? You know that when price comes down here, it may be a good time. So for technical traders, institutions, hedge funds, they're like, oh man, yeah, we're in a financial crisis, but we're going to start buying our position right here. Small bits of it because of this last, what happened back in 2002, 2003, that the price went all the way down to here, and then it pushed back up, right? So we're going to start buying here. So a lot of hedge funds, a lot of institutions, a lot of banks started making their purchases here. So obviously price slowed down because they're buying in the millions and hundreds of millions of shares. And then retail traders said, oh, wow, we have this huge wick on the bottom here. And let me zoom in to give you a better idea. I'm going to redraw those support and resistances, right, real fast. Okay, nice clear picture, right? Now, if you look at this area right here, you have a wick, right? This candle came all the way down here, but it did not close there, right? Not like this candle right here. It didn't close there. It closed up here, above this level. So basically showing that there is buying pressure here, right? And us as retail traders, we can see that the volume is really high, right? This is volume, very high. This is volume of it dropping. But then we have this huge volume day right here, this huge day of buying, or I'm sorry, this huge 3 months of buying right here. This was a turning point of the financial crisis. This is what turned it around. But if you ask me, it's just technical analysis. I don't need to be on CNN. I don't need to look at news. I don't need to look at what the mortgage rates are, the interest rate, FOMC. I don't need to look at anything if I'm a technical trader. I just look at this price point. Well, price stopped here. Therefore, I am buying here. That's it. That's it. And then what do you say, Sarfraz? Well, what if price continues down? Well, that's why you have risk management. And I'll teach you guys how to do that as well. That's why you say, well, I'm going to buy here, but if price goes, let's say, below this level, I'll risk $200 a share. Because obviously, you're not going to risk please don't risk $200 a share for anything. I'm just giving you a facetious example of if you are in the S&P 500, if you're a hedge fund and you're pushing up, most likely people say, well, this area, if it goes below this, I know that this market is continuing downwards. It's going to go further down. So I'm going to stop buying and I'm going to sell my position right there. That way I just have a very small loss instead of it going all the way down here. Then I lose a lot, right? So a lot of people started buying in this area. And then you had one of the longest bull runs ever. And I'll show you. Then the stock market moved. Now it moved in a way where it came back up here. And obviously I'll be very scared right here. If the price came back up here and you bought down here, obviously you want to take some profits up here, right? So price came back again, right to that 1500 meter line, right? 1500 point line right here. So some people will sell right here. Some people did sell, but some people held on to figure out, well, if I get a lower low, like let's say I get a low like this, and then I get a lower high, and then the price breaks this level, then I'll sell. Because then that means we're headed all the way back down to this level again. Now you can really lower like dollar cost average when you have information like this, right? You say, well, if the price comes down here, I'm buying here. For sure I'm buying here because I missed this last one. I'm not missing this next one. But that didn't happen with the price. S&P 500 moved up, broke it. Now this is called a break of structure. This is a huge structure right here, right? That it finally broke. And when this break happens, you have heavy buying. And that's exactly what happened because the price of the stock market went from 1,500 all the way to about 2,500. That's $1,000 move right there, right? I mean, we're talking about the S&P 500, which not many people trade, but that's the move that happened. Obviously, the S&P 500 is a culmination of the 500 top companies in the world, so it moved up. All those companies moved up: Apple, Microsoft, Nvidia, you name it, right? So that was the move that everybody wanted to be in, but it was because it broke this resistance level, right? And it bounced off the support level, right? Key bounces. Now I'm not really worried about what happens after this, but what you need to know is that support and resistance form everywhere. Now this is on the higher time frames. We're talking about a 3-month chart, right? So, but you understand that when I say that technical analysis is, for me, is what you need, you know. But if you're armed with technical and fundamental analysis, like Brother Muzammil here, he's very good at fundamental analysis, right? Then you have the best of both worlds. You can really make some informed decisions about your 401k, your portfolio, your Roth IRA, long-term investments, short-term swing trades, crypto, whatever it is. But if you're armed with just this knowledge right here, if you have to leave this webinar, just leave knowing about support and resistances. All right, go back to the chart real fast. So that's support and resistance. That's the best way I could possibly explain what that is. It's 8:15, a little bit beyond the time of this webinar. So inshallah, these are just more examples of support and resistances, but what I'm going to do is I'm going to skip the moving averages till next week. That's another different way of support and resistances, and we're going to move to Q&A. And then I'll continue these last 2 slides and we'll get into trends and patterns next Sunday, inshallah. But this is all the time I have for today. So if you do have any questions, I'll go ahead and answer them now, inshallah. Yeah, please raise your hands and Brother Muzammil will go ahead and get you guys in. Going to scroll up to see if there's any questions here.